folks, and welcome to the Daily Coin. My name is Rory, and as a contributor at SGT Report, I've been put in contact with some really awesome people from around the world, and today is no exception. I have on the line is Dave Kranzler of Investment Research Dynamics and Mr. Eric Dubin from the newsdoctors.com. And gentlemen, how y'all doing today?
Wonderful, thank you.
I'm well, thanks, Rory. Thanks for having us.
Well, I'm really glad that you guys are here, and we're just going to jump right in and hit it hard. So here we go. Let's talk about Rand Merchant Bank Gold Bond Ponzi scheme. And Dave, you wrote a great article just yesterday, I believe, and we're recording this on Thursday, August the 28th. The article that you wrote, Dave, was "The First Rand Gold Bond Deal is Old Mother Hubbard's Cupboard." And why don't you bring us up to speed? And Eric, do you just jump in because I know you're familiar with this. Just jump in where you see fit.
Well, this first, essentially, the deal was announced last Wednesday or Thursday or something. And it's a gold, or it's marketed as a gold-backed corporate bond that was issued by an outfit called First Rand, which is First Rand Bank, which is a subsidiary of the Rand Merchant Bank. It's a South African based bank, and the way that they marketed it as working is you would send them money, and you would buy interest in a note that was backed by Krugerrands, and it had I don't even remember the specific maturity term on it, but it had a 0.5% interest rate on it, so the interest would accrue at 0.5%, and that would also be payable in Krugerrands. And everything on maturity, everything is paid out, including the interest at maturity. So you're not accruing. You don't get paid current interest the way a normal cash paid corporate bond would do. And then, according to the terms, when the bond matures, you can either receive the proceeds from your investment in Krugerrands plus whatever balance that would be a fractional Krugerrand you'd get in cash, or you can just take cash. So I wanted to take a look at this to see, because the whole thing sounded fishy to me from the beginning, and I wanted to take a look at it to see how it was structured. So I I tracked down who the contacts were at Rand Merchant Bank, and I asked them to send me a prospectus. About 3 days later, they sent me not a prospectus, but a term sheet, and then their marketing brochure. And as I was reading through it, I realized there's actually no part of the transaction that involves gold changing hands until maturity. So the way it works is, if you want to buy the bond, you call up the gold trading desk at Rand Merchant Bank, and you say, okay, I want to buy $1 million worth of your bond deal. And supposedly they buy $1 million worth of Krugerrands and keep it in a vault there. And you get issued a note against those Krugerrands. And then the interest accrues in more Krugerrands. Well, and then as it turns out, at maturity, if you want to redeem your bond in Krugerrands, you actually have to go to the Rand refinery in South Africa, and you alert Rand Merchant Bank 60 days, at least 60 days in advance. You say, hey, I want to redeem this bond in Krugerrands, and then they call the Rand refinery, which makes the Krugerrands, and tells them that, you will be showing up on such and such date, and they're to give you X amount of Krugerrands. Well, who the hell is going to do that? So as I'm reading through this thing, it occurs to me, first of all, there's no evidence whatsoever that the Rand Merchant Bank ever even has these Krugerrands to begin with, because you're sending them money It's the same fractional bullion scheme that we see on the COMEX, that we see on the LBMA, that big banks like J.P. Morgan, they have investment accounts where they tell wealthy guys, hey, we got an account full of gold bars and you're going to invest in that and you'll get the rate of return on the gold and the gold will be sitting in our vault. Well, no one never holds J.P. Morgan's feet to the fire and says, let me see the gold. Is it in an allocated account? Because no, this gold does not go into an allocated account. And nowhere in this term sheet does it ever say that the Cougarans go into an allocated account with your name on it. They're in a fully, if they even exist, they're sitting in an unallocated account. And the note is unsecured.
Well,
Eric, which I specifically found curious because it tells me that in all likelihood, the Cougarans aren't sitting there in the Rand Merchant Bank waiting for the bond to mature and all the bondholders to ask for Cougarans. They're counting on bond investors to not ask for Cougarans.
Exactly.
Yeah.
Eric, is there any difference between this scheme and the GLD and the SLV ETFs?
Well, just the fact that it's attempting to appeal to fixed income investors, and they, will get the pitch of, well, instead of having your asset denominated in U.S. dollars or whatever, it's in gold, and therefore you have a greater level of security, and that would be the marketing pitch. But the thing is that if it's completely unallocated, and if it's phantom gold from day one, unless if you stand for deliver and jump on the plane to get there, the probabilities of your average Manhattan fund manager doing that is next to zero. So it is a way to some extent satiate some of the gold demand up there with a product that doesn't actually entail real physical gold, and that's the problem. The South African economy is tiny, and overall their financial markets are nowhere in comparison to the Western world's large money centers. But something like this could inspire some bright young mind in Manhattan to start offering products like this. So in the Western direct financial centers of Manhattan and London and so forth, and if something like this were to catch on, then it would be one way that the powers that be could siphon off a little bit more of the existing interest in gold towards phantom paper products. And that's the value of bird dogging an example like this and keeping a track on it, because if it further metastasized into the financial system, it would be not a good thing, and people should be made aware of it. Just as people like James Turk, almost since day one of the GLD's rollout, I forget what it was, Dave, maybe you might remember, I think it was 2006 or so, but people have been bird dogging the fact that the prospectus of GLD doesn't have any concrete assurances that real gold is going to be there. It's an unallocated account in more cases than not.
It's just mind-boggling that people still fall for this garbage. I mean, it's
laziness to some extent.
Yes.
Money managers in particular are not as interested in protecting their own monies as they are with other clients' pockets. The due diligence level, despite all the licensing and presumed higher education and so forth, is just meaningless. Bottom line is that when people have their own money, they care about it a lot more than someone else looking after it more often than not.
Yep. That's why I keep as much of mine in my pocket as possible. I'm not giving it to the bank. I'm not giving it to a money manager. I'm not giving it to Schwab or J.P. Morgan or any, Raymond James. I'm just not going to do it.
Your pockets are so heavy, you need some serious suspenders going. You can hear him clanging as he walks down the street.
I don't trust any of them. I don't. And what's going on with the gold and silver market? And Eric, if you'll start us off, it looks like I'm just looking at the ticker right now, and it looks like it had a pretty good bid going on with silver earlier, and it looks like it jumped up to about 1982, 85, somewhere close to 1990, but it's back down to 1956 currently, but it's still up just a little bit. And gold is the same. It looks like it jumped up to about 1297, but it's at 1290 currently, but it's still up a little bit, about $8. Is it just kind of floundering around like it's been the past few weeks?
Well, yeah, and we sliced through the 200-day moving average on gold, and people who rely far more on technical indicators and momentum and so forth, which represent a big chunk of the market on a short-term basis, definitely were, on pins and needles and whatnot. But this is a pattern that we've seen happen many, many times in the last couple of years in particular, where from a psychological point of view, the technical picture looks terrible because the manipulation since, in this case, mid-July onward, I mean, we came very close to the full-blown breakout, and I have egg on my face for saying, hey, silver's about to bust through 22, and when it does that, it's going to take off and probably test 25, within a matter of days remaining in July. And lo and behold, that was exactly when the cartel came in to stop exactly that from happening, because they do understand that there are a lot of people who just kind of sit on the sidelines until some momentum indicator flicks a switch, and boom, everyone rushes in because they think that, this market, precious metals, is similar to other markets in a technical analysis point of view, and more often than not, it's actually wise to trade exactly contrary to what its standard technical analysis would inform, and that's what we're seeing here, and it's to a large extent based on the bid that's underpinning the market from Asian and Russia and other central banks that are looking to accumulate anytime the metals get down to silver in the $19 range. They'll be aggressive, and similarly, gold under 1,300 will do the same, and that's what we're seeing. The fundamentals remain very strong, and even though we'll have periods like in China, for example, where the retail market is backed off a little bit, but I mean, if you look at it in the context of a 5-year window, the demand that exists in China right now still is at a level that exceeds annual mine supply output for gold, and so there's a floor to this market that all of the people like the Proctors of the world and so forth that are expecting gigantic crashes and sub $1,000 gold and on are just completely out to lunch when it comes to their analysis, because this big picture shift, I mean, China, Russia, other nations that are acquiring for 50-year time frames in the transition in the monetary system really don't care much about a $30 move in gold and $2 slide in silver or what have you. They're interested in picking up the metals when the Western world freaks out and is willing to start selling because they're afraid of a continuation of this downturn. So,
if I could play tennis like Novak Djokovic can, I wouldn't be talking to you guys right now. In fact, if I could play tennis like the Frenchman he's playing right now at the U.S. Open, I wouldn't be talking to you guys. I wouldn't even care about the gold market.
Well, okay.
That's really deep there.
Well, thank you, Dave. But in the meantime,
well, I have a slightly different take on the market than what Eric just presented. But I don't agree in the narrative here that the market technically looks bad. If you look at I'm looking at a 4-year chart of the continuous gold futures, and it shows a definitive bottom a year ago in June, and it's in a nice uptrend, and the uptrend where it's kind of hitting higher lows, it'll trade up, pull back, trade up, pull back. We know there's intervention involved here, and it actually, since the beginning of this year, that uptrend has actually started to turn up a little bit. The slope of it's gotten a little bit sharper, and some of the momentum indicators that are kind of the popular technical analysis signals are in their oversold position, and they're really starting to move higher. So, in fact, the MACD started moving higher before gold bottomed last June, and it's got a nice little uptrend to it. So, from a technical standpoint, I think gold's in really good shape. Now, what we have is we've got a bifurcated market, and we see the evidence of this bifurcated market almost every single night. And that is, you've got the fictitious fraudulent paper market of New York and London, and then you have the heavy accumulating physical market that Eric was talking about over in the Eastern Hemisphere. And almost every single night, the gold and silver start to drift higher as India opens up for business, as Hong Kong opens up for business, as Shanghai opens up for business. There's plenty of other countries over there that are also accumulating all night long. Vietnam is the 5th largest gold buying country in the world. Most people aren't aware of that. Turkey, Middle East, etc. So you've got the heavy physical buying that occurs while the Western world is sleeping, and we see a pattern of rising prices overnight. And then as soon as Shanghai and Hong Kong close down and London is open, then all of a sudden gold and silver for some reason start to sell off. So really what you have here is you've got a sort of a fight going on between the physical buyers and the derivatives producing fictitious paper trading world of the Western Hemisphere. And as we know, I mean, you can just look at the COMEX and you can see the value of the paper that's supposed to represent gold is 3 to 4 times larger than the actual amount of gold backing it on the COMEX. And we're not even sure if all that gold is really there on the COMEX. No one's ever seen an independent audit, just like we've never seen an independent audit of the Fed. So, that's kind of where we are. And as long as London and New York-based banks can continue delivering physical gold to the Eastern Hemisphere buyers, we're probably going to stay down in this range under 2,000. But I think at some point, and I actually have some reasons to believe that we're getting closer to that point. At some point, I think you're going to see China and Russia sort of force the market higher in order to bring out more physical gold, because there will be people who bought gold down here. If they can take some profits on it in the, somewhere between 1,500 and 2,000, they'll probably become sellers again. Who knows? Maybe even some of the gold that might be left sitting in central banks in Europe or, I don't know about South America because they seem to be better accumulators, but maybe some of that central bank, that gold that's sort of sitting in the dustbin, might come out also. So that's kind of where I see the gold market now. And I do think, with the caveat that there's no telling to what degree the Fed and the Bank of England will go into manipulation mode, but we are heading into the seasonally strongest period of the year for physical buying coming from India and China because of their festival, holiday, and wedding seasons. So I do think, well, at least the uptrend's going to continue through the end of the year. Where we'll be at the end of the year, I mean, I've stopped putting predictions on where gold's going to go because it's impossible to predict this market because of the degree of manipulation that goes on.
It's amazing.
Yeah. And just as a point of clarification, I actually agree with Dave's assessment of the technical analysis picture. He was speaking of long term, which I 100% agree. But in the short term, the last 3 months, if you look at the window, gold had a subsequent 2 lower lows following that July smackdown around mid of July, and silver as well. And those are the kind of attacks that the cartel does when it's most fearful of the economic backdrop, and if you layer on top of what the price action is showing, the chronology of QE tapering and the overall stress that was visible in the market when it came to the Portugal banking system, and the escalation on the geopolitical front, and Israel attacking Gaza, and ISIS rolling through Iraq. I mean, all this happened within the last 2.5 months in this short-term time frame window, where those actions typically, historically, have compelled aggressive efforts to keep gold as the smoke alarm of the financial system in abeyance, and not triggering fears and whatnot. So now that we are in fact going through the period where the seasonality forces for physical demand is stronger, and the fact that we went down, sliced through the 200-day moving average on a short-term basis, and the very short-term picture was making people nervous. That's exactly when this underlying bid comes in, because the skillful accumulators in China and Russia love to pick up physical when the market is weak, so that they don't have an outsized impact to higher prices. And the point that Dave raised is really important about how, the availability of gold physical in the marketplace is greatly diminished after all of the shenanigans we saw in 2013, and maybe as much as a quarter of the Bank of England's gold inventory may have been pushed out the window. I mean, the amount of physical gold available will no longer service the accumulation desires of China and Russia without prices moving higher to liberate more gold. And we've been living in this, bear market phase in an overall structural bull market, and the upside that will continue will be largely governed by those needs for more physical. And Shanghai is going to have a new market open up on the 26th of September for physical settlement of gold. And I think that, that is going to contribute to a lot more pressure as they seek to build out their gold trading hub. I mean, they're now the largest gold market when it comes to physical settlement, and it's going to get a heck of a lot bigger. So I think, those trends are probably going to end up helping the market stabilize and see higher prices in the not too distant future.
Now, is that in Shanghai, or is that the new Singapore metals exchange?
Shanghai Gold Exchange will be going live with international settlement for gold. They'll even ship out of China, believe it or not, on the 26th of September, according to exchange.
Singapore's opening one up also, and the Shanghai the Shanghai product that Eric's referring to is going to be physical settlement only. So it'll operate differently from the COMEX. If you get long, you got to settle it by taking delivery. So it kind of brings up another point, speaking of China, and that is there's a seriously flawed narrative being promoted in the media and Wall Street that China's demand for gold is down this year. Here's the problem with that. What they do is they first of all, they only reference the World Gold Council numbers, and the World Gold Council only references the numbers that are released from Hong Kong, which show exports to China, exports of gold. And without getting into the complications of how it works between China and Hong Kong, for some reason, the World Gold Council only looks at that number, and it's the only number that's actually available. And the truth is, we don't know how much gold actually is getting imported into China anymore. And the reason is because gold also now enters China through Beijing and also through Shanghai. And those numbers specifically do not get reported. In fact, an article that I have about it out of a Chinese newspaper said the Chinese government specifically opened up Beijing for gold imports so that they could keep their gold import numbers more opaque from the world. But for some reason, the world just wants to grasp on to the World Gold Council numbers. And the World Gold Council is it's a horrific sort of support organization for the Western banks that manipulate the market. In fact, UBS has a metals group in their London office, and they used to be pretty good, but I think they're under marching orders to just, relay the propaganda. The message is gold is not so good. And I have access to their reports via another gold report that we subscribe to for our fund. And they recently have been also harping on this idea that China's demand is down. So I emailed the head of the group and the analyst who's listed on the report, and I said, how can you possibly tell me how much gold is being imported into China? Can you tell me how much gold is being imported through Beijing? How about through Shanghai? And it's been 2 weeks now, and I still haven't gotten a response because the response is obvious.
Yes,
they don't know, and that's what the answer is. So the truth is, despite the message being promoted in the media and from Wall Street, etc., we don't know whether China's demand for gold is up or not year over year. The withdrawals from the Shanghai Gold Exchange, which that Kuz Jansen guy does a great job reporting on, indicate that the demand is down a little bit from last year. And we had the big push in demand when gold got taken down from 1,600 to 1,200 last year. And that's when demand from China really spiked up.
Yes.
However, there's another catch to this, and I've researched this pretty intently. The Chinese central bank, the People's Bank of China, they don't get their gold off of the every person who buys gold in China, that gold was somehow sourced from the Shanghai Gold Exchange. So therefore, the amount of gold that's withdrawn from the Shanghai Gold Exchange equals demand for gold in China, on a weekly basis. However, it does not include the amount of gold that is being accumulated by the People's Bank of China, because the law specifically says the PBOC does not have to source its gold from the Shanghai Gold Exchange. And so that's another black hole for which we have no idea what the number is. So the truth is, gold could be, the gold demand over there could be a little bit lower this year versus last year. But on the other hand, it could be higher, and we would have no idea.
Yeah, but and what you were saying, Dave, demand year over year it appears to be down, but last year the demand was off the chart. I mean, was it last year or was it 2012 when they had just this huge amount of physical gold that moved through the Shanghai Gold Exchange? I mean, it was almost
about 2,000 tons.
Yeah, I mean, but it was almost equal to the entire global mining production, right?
Yeah, that was last year.
So if it's down slightly, I mean, that's still way up.
I mean, China had a big inflection point starting 2011, give or take, and 2012 was a huge year. Everyone was like, "Oh my, look at all this gold demand!" And then 2013 came around, and he's talking about Shanghai Gold Exchange offtake in the 2,000 metric tons range and whatnot. And Lord only knows how much the central bank is accumulating direct purchases from mines. And we've had indications from the Swiss refiners, for example, where deals would be made with a mining company and their doré would be shipped to the refining operations, and then China would be the number one buyer in the line purchasing gold from the Swiss refineries. I mean, to the tune of over 90% or so in the last year, give or take. That reports from refiners have been indicating that all this gold is mostly going to China. So there's definitely some of that stream that's winding up in the central bank in China, and more often than not through direct relationships that it establishes with mining companies and whatnot, and the OTC market where they'll make transactions and fill their coffers in the central bank.
Well, let me ask you guys this, and I'm just your average everyday Joe, and I've got a little bit of gold and I've got a little bit of silver. I don't have very much, but what does the demand in China, what does that mean to me? I mean, in all honesty, we know that the markets are manipulated. All of the markets are manipulated. We've got evidence, for miles and miles and miles of documented evidence of all markets are manipulated. And as far as China and Russia's demand and India's demand and the UK's demand, South America, wherever, if the market is manipulated, how am I going to benefit from that? I mean, does it have to break, or can these guys, as Catherine Austin Fitts has often said, it's a slow burn, and this slow burn, could it take, is it multi-generational slow burn? I mean, seriously, and I'm being dead serious about this.
I think Catherine Austin Fitts wants it to be a slow burner so she doesn't see what happens before she dies. And I feel the same way too, because what's potentially coming is going to be horrific for people in this country, and most people are going to be blindsided. And what holding gold and silver means to you as the average Joe is that you're going to have some protection for when the time comes that the dollar collapses. And it's one of these things that is a slow burner, and then it's going to happen all at once. And what the reason why it would matter to you that people in the Eastern Hemisphere, average citizens, are accumulating, they basically culturally just throw all of their extra money into gold and silver every week or every month,
Yep.
or what have you. And at some point, and who knows when, at some point there will be a gold-backed currency that will be rolled out, and at that point, that's when the tide rolls back, and King Canute United States will be shown to have no clothes on. In other words, the United States relatively won't have any gold. And what's going to happen is the dollar's going to crash, and it'll be like in Weimar Germany. You go to bed one night with $1 million in the bank, and you wake up the next day, and the dollar and the currency's been revalued at a ratio of 1 billion to 1. So you go to bed a millionaire, and you wake up a pauper. And I honestly think that's what's going to happen in this country. And in fact, yesterday it was just announced that Russia is in the process of putting into place a global computerized currency transaction system that will be an alternative to the dollar-based SWIFT system. And to me, that's going to rip out the nerve center of the dollar's reserve status, because that SWIFT system is how the U.S. uses undue political influence over every country when they want to impose sanctions. That's what they cut off Iran from the SWIFT system. Mm-hmm. When they imposed sanctions on Iran a couple of years ago for not wanting to comply with what the U.S. wanted them to do with their nuclear program. So if the dollar-based SWIFT system is taken out of play, think about what that means for the dollar. It means the dollar basically isn't going to be used by most of the world in trade, and so it's really going to really degrade the reserve status of the dollar. And my understanding from reading the article, and I don't remember the specifics, is that they're pretty close to having this thing in place.
No, they've been working on that for a while, and that's through the BRICS Development Bank. Isn't that right?
Again, I don't remember the specifics of the article. I just remember that they weren't too far off from having it in place, and I think we saw evidence of that when it was officially announced that big energy deal that they signed with China is going to be settled in rubles and yuan.
Yeah, no, I knew that. And speaking of that, I mean, with what's going on with oil, I mean, why is oil, plummeting, the past few weeks? I mean, is it because of that? I mean, is that once again the West manipulating the market, saying, we're still the big dog on the block, and and if you guys want to sign this heavy-handed deal, then go ahead, but we'll just drive the price down and put strain on both of your economies. I mean, is that what's going on?
Well, I don't know what Eric's heard, but I heard there's more sellers than buyers.
And there certainly has been some speculation that Russia is being targeted by financial interests in the Anglo-American sphere, targeting derivatives to lessen Putin's revenue stream. And there historically is proof that happened during the Soviet Union time, when the United States was pushing down prices of oil for periods with Saudi Arabian help to weaken the Soviet Empire. But I don't really think that that's the main reason going on here. I think part of it is that you do have economic activity worldwide slowing down. It's happening in Europe. It's now visible in the United States. The level of electricity consumption in China is a relatively straightforward statistic in terms of economic output there, and that was down 10% in Shanghai over July, year over year, and upwards of 20% in some of the coastal areas where they do a lot of manufacturing production for the world. So there definitely is some economic downturn going on here, but it also relates to this overall deflationary type of hiccup that could happen in the marketplace. And Dave wrote an article, I guess it was about a week and a half back, talking about the low end of interest rates on the 10 years, scraping down at 2.3% again, having been 3.03% at December 31st. So we've seen some pretty big moves even in the interest rate segment, telegraphing money manager concern in upping up their exposure to hedging this kind of a deflationary risk in the credit system that's creaking under the surface, that is invisible to most of the financial mainstream because they just buy the propaganda about the economy recovering, and it's almost like Bernanke's 2010 green shoots are shooting up again in terms of what gets reported in the press.
There are no green shoots.
Yeah, they're brown.
Exactly.
Yeah, I agree with Eric. I think a large part of the factor in the decline in the price of oil is the relative weakness of the world economies. I mean, of course, the media in this country is more than willing to report how bad things are in Europe and how weak the German economy is, et cetera. But things are much weaker than are being reported in this country as well, and we've seen it with the retail numbers. Housing sales are slowing down dramatically, despite the headline adjusted annualized numbers that they spit out all the time. So that there's for sure an economic sort of deflationary aspect to it. But what I had heard from an energy trader was that a ton of speculators, and obviously that means hedge funds. Hedge funds piled into oil when all that geopolitical stuff was hitting, and oil ran up to 115. And part of what we're seeing is the speculators selling their long positions and then chasing the momentum downward by getting short. So the evidence that there's not real teeth to this sell-off is that I don't know about Oregon and Tennessee, but in Denver, the price of gasoline, in the time that oil's gone from 115 a barrel down to 95 a barrel, the price of gasoline at the pump has gone from about, and this is for the 91 octane that I use, it's gone from about $3.65 a gallon up to $3.95 a gallon, and in a lot of gas stations around town, it's over $4 now. So if this decline in the price of oil was real, wouldn't we be seeing lower gas prices at the pump?
Should.
Oh, it's the impact volume marijuana sellers over there flooding the economy with everybody's money. And we'll soon have that here in Oregon if it passes in November. But I think the national level of gasoline prices have actually declined. It's at the lowest level since January, if memory serves. And that was reported earlier this week. So
not Denver.
There's also a lag too when it comes to oil prevailing pricing and going through the supply chain through the refiners to the end consumer. It's about 3 months before you end up seeing lower prices when oil itself is falling.
Well, the problem with that is Colorado is an energy producing state, and there's oil refineries in the state. So, search me. I don't know why the price is so high in Denver, but it hasn't been going down with the price of a barrel of oil. That's for sure. Yeah.
Now that you mention that, Dave, that's what's happening here in Tennessee is that the price has actually risen just slightly, not quite. The 30 or 40 cents that you were talking about, but it's gone up maybe about 15 cents a gallon instead of going down instead of, and I do understand, Eric, the lag time that you were referring to, as far as it, the price of oil goes down and then, a couple months later, the price of gas goes down but that's not, it should be in slight decline instead of, slightly going up. I mean, that doesn't make any sense. And help me to understand this, guys. You guys were referring to the global demand being down. Is the national or is the United States demand for gasoline, just pure gasoline for automobiles? Do you guys know if where that trend is? Is it flatline? Is it up? Is it down?
I don't really track it that much. I have a contact of mine who works at a boutique sort of energy-based merchant bank in New Jersey, and that's where I got the information about the speculative run-up being followed by the speculative selling and short selling on the way down.
Okay.
So in terms of what the macro numbers look like for the demand in gasoline nationally. I have no idea.
Okay, fair enough.
I mean,
I don't have the numbers off the top of my head. I mean, we have seen demand destruction, as they say, since the 2009 crash, and we at one point were consuming about 20 million barrels per day in the United States, and it fell down to about 18 or so. And now it's stabilized, and demand is beginning to grow once again in the United States. But in the last 6 or 8 months or so, basically since the start of this year, the trend for gasoline prices has dropped on a national average level. I'm sitting here looking through news stories. I read a news story 2 days ago about this, and I don't remember where the heck it was. If I find it, I'll bring it up, and we can talk about the actual numbers.
Okay. Well, we're getting a little long here, gentlemen, and I could go on for the rest of the day with you guys. I love talking to you. It just means a lot to me to be able to talk to you guys and pick your brains. So, but you guys go get to it, and I will talk with you guys soon.
All right, that sounds good. You guys have a great long weekend.
You too.
Yeah. Nice.
Stay out of the ocean up there, Eric.
Yeah.
All right, guys.
All right. Talk to you later.
All right. Bye-bye.
Bye-bye.